Today is the third and last installment of the series designed to help you understand and pick the right 401k funds for you. The first episode, you learn how to understand your risk profile and asset allocation. In the second episode, you learn how to understand and make sense of your 401k funds available in your 401k plan. And your homework was to take the top funds, take their ticker symbols, so that we can back test it in this episode. My 401k plan does a pretty good job of giving a summary of the 1 year, 3 years, 5 years, 10 years, or life of the fund return. But these free tools that I'm going to discuss today, Portfolio Visualizer and Testful.io, it allows you to back test their historical performances beyond what my plan showed. For the sake of making this video simple and short, I will not go over all the terms, all the tools that I mentioned in the previous episode. If you have any questions, go back to those 2 episodes. In this episode, I will strictly go over how to use the tools to back test your funds so you can see which one historically performed better or worse. Without further ado, let's get started. Since I asked you to do homework in the previous episode to gather the top ticker symbol for the funds that you're interested in, I also did my homework and I have included a summary here. Just like my 401k plan, I grouped them by large cap, mid cap, small cap, international, and target date fund, as well as bond fund. Like I mentioned in a previous video, I like to compare funds within the same category. Large cap funds versus large cap funds, mid cap funds versus mid cap funds to see their performance. What I did was take a summary of all the different funds I have and combine the returns as well as the expense ratios. So it kind of gave me a good summary of the different funds. Out of all the 5 large cap funds that are available to me, this one is the index fund with only 0.04%. The rest are all actively managed funds, charging between 0.47% all the way up to 0.8%. Based on their returns and based on the expense ratio, the 3 funds that I'm going to go over as an example is the VINIX, which is a Vanguard Institutional Index Fund, and TRBCX, T. Rowe Price Blue Chip Growth Fund, and the Fidelity Magellan Fund, FMAGX. For the sake of trying to make sure the report is legible, I'm only going to compare 3 funds at a time, but you're more than welcome to compare 4 or 5 at a time as you please. Click on the backtest portfolio, edit portfolio, go to setting. The time period, you can either go month to month, which gives you an option to select the month within the year, or you can go year to year. I'm going to go month to month, 1998, January 98 through September 2024. The initial investment of $616. Cash flow, contribute fixed amount. Contribute amount is $616. For this example, I'm just going to leave not adjusted for inflation. Contribution frequency is monthly. One thing you'll notice that I put $616 a month. That's because this tool doesn't allow you to do the weekly contribution. In a normal 401k plan, you contribute weekly basis. So I just converted to a monthly contribution. Rebalance, you can say how often you want to rebalance it. I put rebalance annually. Reinvested dividends, absolutely yes. Portfolio asset, if you put default, it just simply put this header here, portfolio 1, 2, and 3. If you put custom, you can rename it. For benchmark, if you want to see how the fund perform against a certain benchmark, in this case, either Vanguard Balanced Index Fund or Vanguard 500 Index Investor Fund. So I'll use that as the benchmark. Let's put in the ticker symbol. The first one is VINIX. Second one is T. Rowe Price. Third one is Fidelity Magellan. In this case, I'm comparing funds performance, not portfolio. So I'm going to change the custom. So portfolio 1 will be the VINIX. Portfolio 2 is the TRBCX fund. Portfolio 3 is the FMAGX. And of course, that's 100%. Put 100% here and 100% here. And click Analyze. One thing to note, the results is limited to 10 years for the free tier account. Even though we put in from January 1998 to September 2024, the result is limited to a 10-year period from October 2014 to September 2024. Another way around that is to do the report 10 years at a time and use the ending balance as initial amount for the next 10 years, but that's too cumbersome, and that's where testful.io kind of fill in a gap. But the reason I started with Portfolio Visualizer, it has a lot of granular data. Just in case you are into data, this would be a good tool to use. Having said that, as I scroll down the list, I will skip over 75% of the data that are available. And that's because my target audience is day 0, an absolute beginner, even though the data provided are useful. But for the intended audience, just to simply drive the investment vehicle forward, those information is not relevant. Like my analogy is more like for a mechanic. You can read through the summary here on your own. The 3 funds I'm comparing are here. And the benchmark is Vanguard 500 Index Investor, which is an S&P 500 index. They all have the same starting balance. The ending balance for the 3 funds are 160,645, 164,688, 161,750, compared to the benchmark of 159,609. This is a performance for that 10-year period. You look at a time weighted return for the 3 fund compared to the benchmark, very close to each other. And the money weighted return, very close to each other as well. Keep in mind, these returns are minus the fees, not including the fees. Standard deviation is how volatile the fund is, and all of them are around mid-teens, except T. Rowe Price is a little bit toward the higher percentage. T. Rowe Price had the best year. The other 2 are very comparable. The worst year, T. Rowe Price has the worst year, and the second is the Fidelity Magellan. The third one is VINIX. Max drawdown, no surprise there. T. Rowe Price had the highest drawdown. Uncheck the logarithmic scale. And the portfolio growth, and you see how they perform graphically. If you recall from the previous episode, T. Rowe Price Blue Chip Growth Fund versus the VINIX, the Vanguard Institutional Fund, their performance are kind of neck and neck, and they trade blows from year to year. You see that T. Rowe Price for quite some time looks like it blows the VINIX out of the water, but when the pandemic hit, it dips way below the VINIX. Now, if you look at the stock performance this year, all of these 3 funds are climbing up at almost the same pace. Annual return, this just shows the return annually for each of the year. Trailing return, I'm going to browse through that. Portfolio income, in other words, the dividend received from each of those funds, or a common word for us is interest. And this gives you a summary similar to the 401k plan. This VINIX contain 99% of US stocks, only a small fraction in international stocks. And it shows the makeup of the fund, 81.5% in large cap, 18% in mid cap, and a fraction in small cap. And it also shows the different sectors that the fund is exposed to. Same thing with the T. Rowe Price Blue Chip Growth Fund. It shows the different asset allocation and the different makeup of the different US stocks, the different sectors. Fidelity Magellan, same deal. Skipping through these, skipping through these, skipping through these. Risk and return metric, max drawdown, just like you saw in the summary section. You look at the positive periods, each of the three funds. When you invest in any funds, you cannot avoid risk. And as you can see, all these three funds, less than 70% of the time, the fund has a positive return for the time period. Under the annual returns, it does a pretty good job of showing the granular data. It even shows you the inflation for that time period. And it shows the dollar amount, the return percentage, the balance, the yield, the income for all the three funds, and the benchmark. And you can even look at the monthly returns if you want to look at how they perform on a monthly basis for that 10-year period. You can more than certainly browse through all this. Drawdowns, if you recall from the previous two videos, I talk a lot about drawdowns. Drawdown is a good graph to look into because it shows you the downside of the fund, right? The negative side of the fund. If you look at these three funds, they are pretty comparable in terms of the risk factor. And except T. Rowe Price, when we had the pandemic, it had a steeper drop than the other two. This just goes back to having a growth fund. You're going to have a pretty good growth, but you're also going to have to be ready for when it does go down. Do you have the stomach to withstand that? It not only shows you the drawdown, but what are some of the historical market stressor for that period and how the fund performed during those stressor. It gives you a nice breakdown of when the drawdown started, when it ends, how long it took, when it recovered by, the recovery period, how long it was under the water for all the funds. That concludes the report. Ultimately, out of all the data points, really for what we need is just to see how the fund compare against each other and against the benchmark. So the most important part about all of these is just to take a glance in the performance summary, how they compare, their ending value and their returns. Look at graphically how they perform against each other. If you want to see the granular data, break it down by annual return as well as monthly return, you're more than welcome to look into these data points. Drawdown, this section is very useful because it gives you a nice graphical presentation of the risk factor of the fund. And the drawdown tabular format, it gives you a nice breakdown of how long the drawdowns was, how long it took to recover, and how long the underwater period and the drawdown percentage. As much as I love the granular data that Portfolio Visualizer provide, it has a limit of only up to 10 years of historical data. And most of the data points, while they're useful for a mechanic, they are more than what we need as someone who just needs to drive the investment vehicle. So the next tool I'm going over is testflow.io. It doesn't have a lot of the data points, but it has enough summary for you and I to do something with. Let's go to January 1st, 1998. Let's end it in September, end of September. Starting value is 616. Cash flow is 616. Contribute monthly. Leave that unchecked for inflation. Click on add for the different ticker symbol. Let's do VINIX. 100%. add another ticker symbol to test. And then the third one is Fidelity Magellan. Rebalance annually. In this case, it's irrelevant because I'm only comparing one fund. I'm not having multiple funds within a portfolio, but we'll go back to that after we're done with this single fund comparison. So what this is saying is I want to look at the performance of VINIX. I want to look at the performance of TRBCX, the performance of FMAGX. As far as the drag goes, I'm going to leave this 0 for now. Essentially, what a drag is an expense ratio or any taxes or any trading costs. And most of all these three funds have expense ratio, but I just want to show without factoring the expense ratio, without factoring the fees, how are these funds performing. Click on backtest. The result go as far back as January 1st, 1998 and ends September 30th, 2024. One thing to note, if you see the exclamation point by the result date, it means that the result returned shorter time frame than your parameters that you set. That is because the limited data for one of the funds. Even though it has less data point than Portfolio Visualizer, I believe this is an easier tool to use for absolute beginners. If you look at the difference between the three funds, T. Rowe Price Blue Chip Growth Fund outperformed Vanguard Index Institutional and Fidelity Magellan Fund. Their CAGR, compound annualized growth, their money weighted return, max drawdown, the volatility. Let's look at the performance. T. Rowe Price, according to this, is outperforming the other two funds. Fidelity Magellan is underperforming VINIX. And if you look at the drawdown, they have very similar risk profile, how far to go down, and the difference up and down throughout the years. But T. Rowe Price Blue Chip Growth Fund has a much steeper drawdown and a longer underwater period. Again, this goes back to when you go for a growth fund, you may enjoy some of the growth, you may enjoy higher growth, but you also have to make sure you have the stomach and the stability to withstand the potential downside. And then the last three metrics, it's something that you really don't need to know about. Really, this is it right here. This gives you a nice summary of how the funds perform, its performance, and its risk profile. Without factoring the fees, T. Rowe Price ending value from 98 to 2024 at 1.2 million versus VINIX at 1 million and Fidelity Magellan slightly under a million. Now let's factor in the fees. VINIX is 0.04%. So that's a drag. T. Rowe Price is 0.7. Fidelity Magellan drag expense ratio is 0.47. If you recall, I repeated multiple times in the first two episodes to compare the fund's performance. Don't forget to factor in the fees. As you can see, when you factor in the fees, T. Rowe Price Blue Chip Growth Fund, the ending value is 1.07 million, not the 1.2 million, because the other almost a quarter million is going to the funds manager. And if you look at the VI9X, the ending value is still 1 million because the expense ratio is only 0.04%. You get to keep your money, and your money continue to compound. So now you look at the performance with the fees. Fidelity Magellan, even though it's actively managed fund, it's underperforming the other two funds, and it's underperforming the S&P 500 index fund. As for T. Rowe Price Blue Chip Growth Fund, I won't deny that it does have a very high growth potential, but it also has a steeper risk as well. Not to mention the fees that go along with it. So it's up to you to decide which fund is best for you. Now, keep in mind, I'm only showing the 3 returns for these 3 funds. And you can use the same method and plug in the different funds that are available for you, and you do your own compare and contrast for the funds that you're interested in. What I just showed you is how to compare funds performance against each other, but your portfolio doesn't have to be just one fund. It could be a combination of funds. So maybe individually they are comparable, but how will they perform if you start combining some of it? Let's try this out. So out of the 3 funds here, really Fidelity Magellan is not something that I would look into. Fidelity Magellan used to be a very good fund when Peter Lynch was a fund manager. But since his retirement, the fund hasn't been the same. This just go back to the risk that you have with the actively managed fund. It can only be as good as the fund manager. And you look at the life of the fund performance, it can also be skewed by historical performances that may not reflect the current performance, and vice versa. Having said all that, out of the 3 funds that I looked at here, Magellan would not be on the top of my list. It could be yours, but not mine. And don't follow me just because I say so. Do your own research and based on your circumstance. So in this case, let's delete Magellan. Let's keep these 2. But what if I want my portfolio, instead of picking one and not picking the other, what if I want both? Let's try a different combination. Let's say VI9X and T. Rowe Price split 50-50. Let's do that. Unfortunately, when you do a portfolio consisting of different funds, it doesn't give you the option to put the expense ratio for each of the individual. It only gives you the drag for the whole portfolio. Just to keep it simple, 0.7. I don't know, this drag, because it's 50-50, I'll call it 0.74. Because you don't have it at fund level, let's just make this 0 for easy comparison. 50-50 split. What about 75 VI9X, 25 blue chip? Let's reverse that. 25 VI9X, 75 blue chip. To sum it up, you can use Portfolio Visualizer to give you more granular data points, but the majority of those data points will be more confusing than it is helpful. Testful.io It doesn't give you a lot of data points, but it gives you the most important data point, which is the performance and the risk factor. You can use testful.io to not only test individual funds' performance, but also add in the expense ratio for each of the fund. And if you want to start testing different combinations of funds, you can also play around with that number. But the only downside is you don't have the ability to put in different expense ratio for the different funds because it's at a portfolio level. And what testful.io really helps cement the idea that just because it is actively managed fund, just because it has a high expense ratio, it doesn't mean it's always going to give you the best return. If anything, it probably give you the worst return with a lot more risk. And that's something that you have to factor in based on your risk profile. Is the fund the right one for you? As usual, the intent of this channel is to never give you a blanket advice. I don't tell you to pick fund XYZ. I'm simply giving you the tools, the information. Now it's up to you based on your personal circumstance, based on your profession, based on your income, your expenses, your risk profile. You decide what funds are best for you, and you decide what combination of funds are best for you. What I can do is kind of give you a high-level overview on some of the things that certain people in a certain group may choose to do and why. But it's still up to you to decide and do your own research beyond this to determine what is best for you and your family. Keep in mind, investing is a 4-quarter game. Don't be too short-sighted on the 1 year, 3 year, 5 year, and 10 years. You have 35, 30 plus years of investment. And in the long run, anything can happen. If you are early in your risk profile in the first quarter of your investment journey, then I'm going to go against what the expert recommend, a mixture of stocks and bonds. If you're in the first quarter of the game, you have a long years ahead. You have 3 more quarters of your investment journey. In that case, having some bond may not be best for you because while it protects you on the downside, it's not gonna give you as much growth potential. So I would look at more in the fund that are heavily in stocks or almost 100% in stocks. But which one of it is up to you. Based on the available funds available to me, even though the experts suggest having exposure to international stocks, financially it doesn't make sense for me to invest in international stocks with historical poor returns with a very high fee. Same goes for bonds, even though the experts suggest the bond ratio early in your first quarter of investment journey, having these low returns, it doesn't do you any good either. If you're still in your first quarter of your investment journey, but you just want to set it and forget it and never have to worry about it again, in that case, picking one of the target date fund that match your retirement year might be a good option for you. As long as you're good with having around 8% return, but you set it and forget it and never have to worry about it because the fund manager will do all the different allocation for you as you progress toward your retirement years. Now, if you are in closer toward the end of the retirement phase in the third quarter going to the fourth quarter, then having exposure to all stocks is not a wise choice because even though it does give you high growth potential, you also have a very high risk. You could be losing half of your portfolio and there's no telling when it's going to be happening. And it could be happening just before you're ready to retire. Now you have half of your investment gone. So if you are closer toward the retirement in the third toward the fourth quarter, then for sure you want to have some sort of bonds in that. You hear it on the news with the financial crisis and how people lost their investment. You know, you don't lose investment. You don't lose all your 401k. You only lose when you start withdrawing from it and when you start selling it. This concludes the mini series that is designed to help you pick the right 401k fund for you, but it's not the end of 401k. I will have more episodes regarding different aspects of 401k, but that's further down the line. Until then, take the time to plug in the numbers, see how the funds historically performed. Look at the different asset and asset allocations for each of those funds. Look at the returns and the risk profile. One thing I want to reiterate and end with is it is extremely important to align the fund's performance and risk profile to your risk profile, not the other way around. Don't pick funds because experts on MSNBC, social media is telling you to pick it. Perform your own research.